who we fund and why. And this really is not who we fund or it's what we'll fund. Again, it goes back to taking a look at the asset, and we hear all kinds of stories and scenarios. But working with a lot of different types of people, and usually very real estate astute veterans in the real estate market that have a scenario where they're buying or refinancing or cash out for different situations where they can't get a loan from their conventional bank. And we go back to structuring loans at work, and the exit strategies. We like to create a loan that satisfies their immediate need, but also gives us a plan where we'll get the money back on a structured term, and then take those funds and put it onto another loan. We do find that we have to modify sometimes based on the market or the particular client's situation. So it's just structuring loans to every different type of situation you can imagine in this real estate market. And in saying that, looking at the Bay Area proper, from San Jose, California to Marin, from San Francisco up to Sacramento, it's kind of a geographic area that we stick to. 80% of our loans, I think, are there, but it's a great hotbed right now for real estate, and we're seeing a lot of opportunity with the expansion and growth here. In saying that, one thing that we haven't touched on, just moving into this next thing where we're getting into scenarios, when we're doing our underwriting, we lean a lot on the brokerage community. And so, as Vance mentioned a minute ago, we're going into a particular neighborhood, and if we're going to the Oakland market, we're looking at maybe apartments. We will contact one of our clients or a broker that we work very well with. It's an expert in that market, and they know the sales cycles. They know the owners. They know the lease rates. They know the terms of the leases. They know the buildings themselves, and we'll drill down to what the real value is with those brokers that are experts in those specific submarkets to come up with our valuation. And there's a big difference between a borrower's valuation and the bank side valuation. So when going in and doing these underwriting, we look at a lot of those and come up with where we're comfortable. In the next paragraph, the bank may deny somebody in bad credit. We see good borrowers that have bad credit, and simply because they may have a large portfolio of properties and they may be extended on their credit, and it dings them, and where a bank looks at cash flows and income and puts all those modules together, and they come up with a credit situation, and they're a credit risk when they're not at a debt coverage ratio that meets the bank standards. We tend to sort of put that aside and go, what's the asset worth, and make our loan based on our underwriting criteria. Single family bridge loans. So where we're located in Lafayette, we do a lot of these bridge loans on single family homes. We talked about a little bit earlier. Northern California has a lot of move up buyers, and there might be a property that's coming to market or that is on the market, and a family decides, hey, we want to go after that asset. So we can do a less than 1 year bridge loan, interest only, no prepayment penalty, and do a cross-collateralization loan on both properties, securitizing both properties, and a first, maybe second deed of trust, and wrapping it around their existing home. And then we get paid off when the existing current home sells. So that's a scenario we see pretty regularly in some move-up buyers in this area, and we're happy to do those too. I think our focus is commercial, but a growing percentage of our loans in the fund are now becoming a single-family home bridge opportunity.